Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Navigating the Tax Cuts and Jobs Act for the Wine Industry. And before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have two speakers with us today from Moss Adams. We have Sara Harper, partner, and Katie DiBiase, senior manager. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Sara to get us started.
Thank you, Amy, and good morning, everyone. We're going to spend the next 30 minutes talking about the Tax Cuts and Jobs Act and specific provisions that are scheduled to sunset at the end of 2025. The focus of our presentation will be on those expiring tax provisions within the TCJA that will have a more significant impact to taxpayers in the wine industry. Before we dive into those specific provisions, we wanted to give a brief recap of how we got here. The Tax Cuts and Jobs Act became effective January 1 of 2018. The tax bill was one of the most extensive tax bills we'd seen in decades, and built into the tax law were several provisions that were scheduled to sunset as of December 31st, 2025. For those specific parts of the law, the tax law will revert back to the laws in place before TCJA's enactment. And because the sunset is part of the law, it will take an act of Congress in order to prevent it. There are several provisions that are included in the TCJA that are not scheduled to sunset, which we will mention later in the presentation. However, our focus is on those provisions that are scheduled to sunset so that you can understand what those provisions are and have time to take appropriate action as needed. I can't advance the slides. I'm sorry. I don't know where they are.
I got it for you, Sara.
Okay, thank you, Katie. Sorry about that. There's quite a bit of uncertainty around the tax law, especially as a result of the recent election. It is expected that tax talks will resume very soon, and with Trump winning the White House and the GOP in control of the Senate, we expect there will be a significant push to extend as many of the provisions of the TCJA as possible. These changes in Washington could also result in a challenging future for the IRS, with Trump potentially cutting the funding and putting the brakes on enforcement campaigns. It is not expected that any tax law changes will happen until much closer to the end of 2025, so we would encourage you not to wait to plan for those potential changes.
Great. Thanks, Sara. Moving on to changes for corporate versus pass-through entities and what opportunities might arise when assessing which structure could be the most beneficial for your business. So the Section 199A deduction, that's the 20% qualified business income deduction for pass-through entities. This 20% deduction expires at the end of 2025. This deduction was put in place to help balance the tax rate differential between corporate and pass-through entities. And the decreased corporate tax rate of 21% is not set to expire. That's a permanent one. So there's going to be a real rate differential depending on what type of entity structure you have at the beginning of 2026. So a few things to consider when you're thinking about these entity types is, do we think that the 21% tax rate will remain for corporations? Well, that's to be seen, as there's been talk post-election of potentially reducing that corporate tax rate to 15%, but only for domestic manufacturers. A few considerations. Would you consider evaluating your entity type with Section 199A set to expire? So if you're profitable and a pass-through entity, meaning you're taxed as either a partnership or an S corporation, and you currently have this 20% deduction, you can expect an increase in your effective tax rate. To add to that, the top tax rate for individuals is going to increase from 37 to 39.6%. So the combination of these two impacts will cause a 10% increase in the effective tax rate for business income. And we've got an example of that on the next slide where we will illustrate this, and you can see the impact it will have on a profitable company. So another question, is there an opportunity to accelerate income into these low tax rate years? Can you accelerate income into 2025 or defer deductions into 2026? Have you evaluated your accounting methods to identify potential opportunities to accelerate income into the low tax rate years, whether it's your overall method or individual item methods? These are discussions you want to be having with your tax advisor about what makes sense for your individual tax situation, or please feel free to reach out to me or Sarah to get that conversation started and explore some of these questions. One thing to note, if you're considering a change in structure to a C Corp, one item you'll want to consider is your rate of reinvestment versus distributions through your dividends and how that will impact your effective tax rate. So something to look at when considering the C Corp structure. Next, we'll this is our illustration of the Section 199A deduction. So as you can see, in 24 and 25, we have the same tax situation on a business owner that has $2 million in qualified business income. You are currently set to get a deduction of 20% of that qualified business income, or $400,000, which reduces taxable income to $1.6 million. Going into 2026, you don't get that deduction. You're still being taxed at the $2 million. And as you can see, the tax rate increase jumps from 37% to 39.6%. And that equates to a $200,000 difference, or 10% on that $2 million. So significant difference between 2025 and 2026. Talking now about bonus depreciation in Section 179. So with the TCJA, the bonus depreciation was 100% through the end of 2022. And in 2023, it dropped to 80%. And now the plan is for 2024, 25, and 26 to drop by another 20% each year. So 60, 40, 20, and 0 from 2027 forward. With this phasing down, will that change as a result of the election and Republicans controlling both the White House and both chambers of commerce? Well, this remains to be seen, but if I had to guess, I would guess this is one area that I think Congress will make a priority. However, that's not our only option when it comes to depreciation and 100%. It brings up another opportunity to reemerge our enhanced Section 179 expensing. We've not seen this utilized in recent years because bonus has been at 100%, but we started utilizing it again in 2023. And what it does is it provides for $1 million in deductions on eligible assets, with phase out starting at $2.5 million. And that is adjusted annually for inflation. So for 2024, our amounts are $1.22 million, and the phase out starts at $3.05 million. So above this $3.05 million, the benefits reduce dollar for dollar after you cross that mark. And so you get a full phase out at about $4.3 million. Now, there are a couple limitations to Section 179 that you'll want to consider, which is why bonus has proved to be a more beneficial option when both provided 100% deduction. The entity claiming the Section 179 expense must have taxable income in order to utilize this deduction. And the ultimate taxpayer also must have overall income. So the $1.22 million deduction limitation and the $3.05 million place in service limitation also applies at the taxpayer level. So if you have ownership in multiple entities, those deductions and limitation thresholds are aggregated at the taxpayer level, which can create a taxpayer limitation, even though no limitation exists at the separate businesses. So planning consideration with bonus phasing out is, are there opportunities to revisit your repair deductions? Is there anything you've been potentially throwing into a capitalization bucket because you're still getting 100% bonus in the past? And now maybe you revisit what is being capitalized and if there are items that could potentially be considered a repair or a replacement of something and not truly a betterment, improvement, or upgrade that's required to be capitalized. Back to you, Sarah.
So one of the provisions that's received quite a bit of attention since its enactment is the limitation on the state and local tax itemized deduction. The TCJA placed a $10,000 limitation on the amount of state and local taxes that an individual can deduct. This limitation is often referred to as the SALT cap. In response to the SALT cap, many states enacted legislation to adopt a pass-through entity tax regime as a workaround to this limitation. Each state has different rules for what will happen if the SALT cap sunsets or is otherwise modified. For some states, the pass-through entity tax program will continue. For others, it will follow what happens at the federal level, and other states have their own statutory expiration. Therefore, we recommend that you work with your tax advisors to understand what will happen with the pass-through entity tax programs in the states in which you participate in this. One of the provisions of TCJA that is not sunsetting yet is the excess business loss limitation. This provision was originally set to sunset at the end of 2025, but the Inflation Reduction Act extended this limitation through 2028. Under these rules, non-corporate taxpayers are subject to a limitation on the amount of business losses that can be used to offset non-business income. Losses that are disallowed under the excess business loss limitation are carried forward to future tax years and are treated as a net operating loss carryover in the carryover years. The excess business loss limitation in 2024 for a single taxpayer is $305,000, and for a married filing joint taxpayer, it is $610,000. Let's walk through an example of how the excess business loss limitation is applied. In our example, T, a single taxpayer, has business deductions of $555,000 and gross income from their business of $200,000. This results in a net business loss of $355,000. Since the limitation is $305,000 for a single taxpayer, T has an excess business loss of $50,000. The $305,000 loss allowed can be used to offset other non-business income that T has in this tax year, and the $50,000 will carry forward as a net operating loss. For California taxpayers, it's important to note that California has its own version of the excess business loss limitation. The limitations are the same as federal. However, the disallowed losses are treated differently in the future tax years. As mentioned, for federal purposes, the disallowed loss carries forward and is treated as a net operating loss in the future years. However, for California purposes, the disallowed loss does not convert to net operating loss, and the excess business loss carryover will only be available to offset net business income. If this limitation applies to you, it's important that you talk with your tax advisors to understand how you will be able to utilize the federal and state carryovers that you have. While not part of the TCJA, we did want to share another specific note for taxpayers in California. On June 27, 2024, the state enacted Senate Bill 167. This bill suspends the use of net operating losses and places a limitation on the use of tax credits. This suspension and credit limitation applies for tax years beginning on or after January 1 of 2024 and before January 1 of 2027. The NOL suspension will apply to taxpayers with $1 million or more in taxable income, and the credit limitation does not allow taxpayers to utilize more than $5 million of credits to offset tax in a tax year unless a specific exemption applies.
Moving on to our expiring fringe benefits. So the only one really on this slide that I think is applicable to our winery clients is the first one. So food and beverage expenses for on-site cafeterias and meal plans has been reduced to 50% in 2024 as part of the TCJA. But if de minimis and on-site for the convenience of the employer, no deduction will be available going forward. You can also note the differences in the moving expenses and bicycle commuting reimbursements, but we don't typically see these a lot for our winery clients. So for our business provisions that are not currently subject to change, Sarah mentioned some of these briefly. We've got the corporate tax rate at 21% that we've already discussed in detail. And then we've got the net operating loss limitations. So as mentioned on the previous slides about excess business losses, they're generally limited to 80% of taxable income, and then the remainder is carried forward indefinitely and available to offset future income. The interest deduction under 163J, which is also known as the excess business interest expense limitation or EBIE limitation, limits the amount of business interest to 30% of adjusted taxable income. So this is a permanent change, assuming no changes come from Congress related to this item, but I would not be surprised if this one gets some scrutiny, as it tends to be pretty taxpayer unfriendly, depending on your level of leverage. Like-kind exchanges, those were changed to real property only with the TCJA. No personal property is available for those. I don't expect that would change. Research expenditures, so specified research and experimental expenditures, also known as SRE expenditures, required to be capitalized and amortized over 5 years, 15 if it's foreign activity. We've seen a lot of this in the winery industry, and it's been a pretty burdensome provision for our clients. So it's one that has also seen a lot of talk in Congress of repealing. So we will see what happens going into 2025 and if that one gets repealed. The small business accounting methods, these are still going to be available. So originally it was for small business taxpayers with average gross receipts of less than $25 million. That's been adjusted annually for inflation, and the current figure for 2024 is up to $30 million now. So which methods are we talking about with this? Well, the ones we commonly see providing benefit in the winery practice relate to inventory, or that's one of the main ones. Eligibility for the NIMS method, or non-incidental materials and supplies method, not having to follow the UNICAP methods of 263A and those rules has been a big benefit for a lot of our clients. Also, cash method and exclusions from that interest expense limitation of 163J are all still applicable permanent methods that are eligible to small business taxpayers. So if you are under that $30 million gross receipts mark, these small business accounting methods are still available to you. And if you're right on the cusp, this could be a great opportunity for planning. Continuing with the business provisions not currently subject to change, we have the enhanced 179 expensing that we talked about. Again, that's 1.22 million for 2024, phase out starting at 3.05 million. Reduced dollar for dollar over that limitation. Fully phased out is $4.27 million. We had the elimination of the corporate AMT with the TCJA, and that repealed the 20% AMT on alternative minimum taxable income. However, the IRA created a new corporate alternative minimum tax that imposes 15% on the adjusted financial statements of applicable large corporations. So we don't see this one a lot in our winery space because the average annual financial statement income has to be more than $1 billion. However, one thing to note, that the threshold amounts are lower in the foreign realm. They drop down to $100 million. So that would be something to be aware of only if you have some foreign corporate ownership. Again, not something we see frequently, but did want to mention that lower threshold. Entertainment expenses, there's still no deduction allowed for that. And transportation fringe benefits are being adjusted as well.
So now we're going to switch gears and talk some about individual tax provision changes. The individual income tax rates are scheduled to revert back to pre-TCJA levels starting in 2026, which means the highest marginal rate for federal purposes will be 39.6, up from the current 37%. In addition, TCJA reduced the overall impact of AMT by enacting a higher AMT exemption and increasing the income level at which the exemption begins to phase out. These will also revert back to pre-TCJA levels in 2026, meaning that it's likely more taxpayers will be subject to alternative minimum tax. Given the change in tax rates, now would be a good time to consider revisiting your IC disc or considering an IC disc if you don't have one. If you have an IC disc in place, it would be a good time to review the methodologies with your CPA to ensure that you're getting the most benefit you can, especially if we're looking at an increase in tax rates in the coming years. The personal and dependent exemptions are scheduled to return in 2026. The exemption amounts will be $4,150 for each taxpayer and qualified dependent, and will phase out for high-income taxpayers. In addition, the standard deduction is scheduled to reduce back to pre-TCJA levels. As you can see on the table provided, for married filing joint, the current standard deduction is $29,200, and in 2026 is scheduled to go back to $13,000. There are also some changes to itemized deductions that you may want to consider. The itemized deduction phase out is scheduled to return in 2026. With the phase out returning, some itemized deductions will be reduced by 3% of the amount by which AGI exceeds a threshold amount, with a maximum reduction of 80% of total itemized deductions. Now, certain itemized deductions are not subject to this limitation and instead are subject to their own limitations, and those include medical expenses, investment interests, and charitable contributions, among others. As previously discussed, the limitation placed on the state and local tax deduction is scheduled to sunset at the end of 2025. Another itemized deduction that we'll potentially see some changes in is the mortgage interest deduction. Currently, under the TCJA, mortgage interest paid can be claimed as an itemized deduction on the first $750,000 of home acquisition indebtedness originating after December 31st of 2017. And interest on a home equity loan is permitted only if the funds are used to buy, build, or substantially improve the home that secures the debt. When this provision sunsets, we will return to the pre-TCJA rules, which provide that interest is deductible on the first $1 million of home mortgage interest debt, plus up to $100,000 of home equity debt. The interest on the home equity lines of credit secured by a qualified residence will be deductible on up to $100,000 of debt regardless of how the loan proceeds are used. In addition, the itemized deduction for cash contributions will be limited to 50% of AGI, where under the current tax law, they are limited to 60% of AGI.
Okay, miscellaneous itemized deductions. These are the deductions for certain expenses which exceed 2% of AGI. So this returns in 2026. Some of the expenses are expenses for the production of income, which includes investment fees that you might see on a brokerage statement, hobby expenses, safe deposit boxes, tax prep fees, and unreimbursed employee business expenses, home office deduction, educator expenses, union dues, etc. Changes to the child tax credit. Currently, we're at a $2,000 per qualifying child, $500 for other types of dependents, and that credit begins to phase out at $400,000. For married filing joint, $200 if you're single or head of household. In 2026, we're going to return to the pre-TCJA levels, which is $1,000, not indexed for inflation. And the phase out is a lot lower. It starts at the $110,000 for married filing joint, and $75,000 for all other taxpayers. Now moving on to the estate, gift, and trust side of things. So this is a big one, and I really want to drive this one home. In 2026, the estate exemption is scheduled to revert to the pre-TCJA levels adjusted for inflation. The federal tax rate above that exemption is 40%. So in 2024, we're looking at 13.61 million per individual and 27.22 per married couple. In 2025, it's going to rise to 13.99 million per individual and 27.98 per couple. So in 2026, when we return to our pre-TCJA exemption of 5.6 million adjusted for inflation, we are expecting about $7 million for individuals and about 14 million per married couple. So what this means for you is get started now. If you have not done any estate planning, you have in your estate more than $7 million or $14 million if you are a married couple, you should seriously be considering taking advantage of this before the provision sunsets at the end of 2025. It's a great time to consider gifting opportunities before this exemption is significantly reduced. This is one of the provisions that's a use it or lose it situation if it doesn't get changed by Congress. And this is not one that seems to be at the top of the priority list either for changes coming from Congress. So if you're someone who's wanting to transfer wealth at any capacity, now's the time to think about it. Many different ways that you can transfer wealth and still have access to the cash flow. So it's something we can help with, or talk to your current CPA or attorneys to see what can be done now to take advantage of the current exemption. One thing to keep in mind is that states are different and they will have their own thresholds on these types of taxes. For example, there's no gift tax in Oregon, but the estate threshold is a much lower $1 million. Also, California has no estate tax and no gift tax. Oh, Sarah, you're still on mute.
Thank you. We've discussed many different tax provisions that are scheduled to sunset at the end of 2025. And while the future of these tax rules remains uncertain, it's important that you plan ahead while you still have time. We suggest that you work with your tax advisors to model the impacts of these expiring provisions and evaluate whether you have any new planning opportunities as a result of the changes. Look at your accounting methods to see if you can take advantage of the lower tax rates during 2024 and 25 and potentially save deductions or expenses for years with higher tax rates in 26 and beyond. We recommend that you consider the timing on upcoming transactions while keeping these expiring provisions in mind. And as Katie mentioned, be sure to review your estate plan to identify opportunities to take advantage of the increased exemption while you can. We really appreciate you taking time with us today and hope that you reach out if you have any questions. I'll turn it back to you, Amy, to close us out.
All right. Well, thank you, Sarah and Katie, for a short and sweet presentation today. We really appreciate it. And to our audience, if you have further questions or comments, you can reach out to us and we would be happy to continue this conversation. You can drop a note in the Q&A window now or reach out to our presenters directly. Their contact information is in your console. And then finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. And again, thank you for joining us and take care, everyone.
Thanks, everyone. Have a great day.
Bye-bye.